So I hope you're as excited as I am now. And I think, well, looking at our broad topic, how to master the perfect FX strategy, of course, that's not easy. Otherwise, we won't be sitting here. Now, Firdas, I will go to you first with your trading experience. And of course, there are lots of, I don't mean to sound plain, but there are a lot of rules. We hear every day, trade is your friend, and so on, so on, so on. But what, in your opinion, are the most essential rules of trading?
Yeah, of course. When we are talking about trading, you cannot tolerate or you cannot deny that one of the factor in trading is losses. We cannot avoid, and you have to accept that losses, right? However, in order to success in this trading, you have to minimize and reduce the losses. That is what comes the good trading strategy. For me, by my personal, there would be three elements in a good trading strategy. Number one, the 20%, and you have to learn about the technical analysis, fundamental and the sentimental, right? Number two is you have to manage your money and risk management. You cannot be like trading like crazy people, you know. You don't know what you are doing in the market. You are trading a big lot size in the market when you don't have enough capital in your account. And that is 40%, I would say. Another 40% is about psychological, right? You have to be ready in terms of your emotion and your psychology. Because most of the traders, they are failed 80% of this trading strategy, and then they are making losses. They cannot mitigate all these risks. Yeah. So there's no holy grail technique or trading strategy in this world, basically, right? So you have to make sure that when you plan for your trading strategies, you have to make sure that your objective is clear. You have to minimize your loss and maximize your profit, right? So when you have this objective, I'm really, really sure that you can really, really be a successful trader in the future.
Thank you. So, Firdas, of course, you have mentioned two words we hear a lot, technical fundamental analysis. Now, Naim, in your opinion, and I know it's a bit of a holy wars here, but let's hope we'll not get too aggressive. But Naim, in your opinion, what's more important, technical or fundamental?
Okay, thank you. So I think, look, if you are interested in day trading, what matters the most is the price action. Tesla isn't going to increase the production of their cars by 10,000, 1 million, whatever the number, in one day. Tesla will increase its production of cars over the period of times. That will impact their margins, their profitability, and of course, not to mention the most important one, geopolitical conditions. In a day, this is not going to happen. So if you are an investor who understands what the fundamentals are and you have a long-term horizon, I think fundamentals are great. But if you are just there to make few ticks here and there, then technical analysis is very, very important for you because it's driven by price. But within technical analysis, there are so many different things that we discussed yesterday on our panel at 11 a.m. It's not about RSI has dropped over here, you go trading, you do this and you do that. That's not it. And I can tell you from my own personal experience, I do not engage myself in any sort of a technical trading unless I have done the back testing on that. And then I'm not referring to the normal back testing. I'm talking about you have a data for it, because if you just back test a certain strategy over 12 months, I can guarantee you any indicator can fit that. And then that will be, you'll be digging your graves yourselves. It is about you test your strategy, for example, over a period of a year for 6 months, and then still in the back that period, you'd see if that particular strategy has worked over the next 6 months, still the time has lapsed. If it works, then you move. But applying statistical analysis is the most critical, and it varies so much from instrument to instrument. I think these are the most important things.
Would you say it also depends on the asset class?
It depends on the asset class, of course, because if you are trading Forex, you got to know your economic calendar. That's where the fundamentals comes back in. You don't want it to have a position and then you have a retail data coming out, you have a consumer spending data coming out, central bankers are speaking. So this is why it is important. And I seriously say to you guys, this is not a 30-minute job. This needs hard work. It needs discipline, as he said. Because you could have a 1% loss every day. You can say that, okay, my risk management is a 1%. But trust me, we all been there. Losing 1% a day, in 10 days in a row, means 10% of the capital is gone. To overcome that stress, that psychological element, it takes guts to still remain disciplined.
Spot on. Well, my background is technology, so we do technology for brokers, right? So we see all of you guys. We have an overview on how the brokers run their books, how are the traders trading. And we see very often that there are two types of behavior, right? So sometimes traders would trade the market using fundamental and technical analysis. But you can also see traders that are trying to trade the abnormalities. And there is one more person on this panel who works a lot in B2B field and sees a lot of brokers. So Arthur, in your opinion, do you see more traders trading the abnormalities or the market? And what do you think is more profitable? Like, what would be your strategy?
Thank you, Elena. It's a very good question, actually. And I think we see more or less the same that what you see, actually. But before I reply to that question, please allow me to give one golden rule. So the golden rule is before you go for the trading, you have to be honest with you, and you have to define yourself first, who you really are. Are you trader or are you investor? Because it's completely two different definitions, and this is two different approaches, how you are going to deal with all of that, with all the capital markets. If you are a trader, you have to follow certain strategies and certain rules, and the rules are very, very simple. As Naeem said, and my colleague from Fullerton Markets, yes. So that's why if you are an investor, you have to build your portfolio strategy, right? And it's completely different approach. It's about risk management, it's about diversification, it's about sectors, and it's about asset classes, and about long-term vision. So it's completely two different approaches. Now, about, Elaine, your question. So first of all, of course, we see a lot of spikes during the abnormal market conditions. And
We talked about that yesterday a lot, right?
Like, yeah, it's always during the news, and especially important news, we always see the spikes, and all the systems, they get overloaded. And that's why at that moment, the many traders, they try to get into the market, because sometimes, obviously, you know where price is heading to, and if you are able to catch this just 2-3 second trade, of course, most of the time you are going to be profitable. But the problem is that everyone is doing the same. And that's why when the liquidity providers receive all that numbers of trades, obviously all those trades, they are making huge impact on the order book, on the market, and all these traders, they sweep the book. That's why it's so-called slippage definition. In reality, it's not a slippage, it's a market impact. So that's why, yeah, Lena, answering to your question, abnormal, how they are profitable, I cannot tell you because, you know, I don't do so personally. I don't do trades, but I see that the spikes in terms of the volume increase at that abnormal trading conditions.
Yeah, coming back to sweeping, I think just to provide some context here, I think we're the only market in the world where when you buy more, you have to pay more. Because if you want to buy something else, if you buy more, you have to pay less. In this market, the more volume you want to get executed or filled, the more markup you have to pay. So, Naam, so a really good point. So do you think it's actually a sustainable strategy to be trading the abnormalities? Or do you believe it has to be like a consistent strategy of day trading?
That's an excellent question. And then I think this is why I want our audience to really understand. A lot of educators out there, they will have a strategies. Go trade the news. Let's trade the US non-farm payroll. And then honestly, trading US non-farm payroll, trading central banks meetings, trading the data is one of the most difficult element. Broker is against you. And I don't mean the broker is against you in a way that they are taking the positions against you. I am saying the liquidity, what he said, is not going to be there. They're going to increase the spreads dramatically. So you have one major odd sitting against you. Secondly, any of the central banks, even though they've increased the interest rate, they could throw a dovish comment. And you could say, oh God, that came exactly how I wanted, but it didn't. So that's why wait after, because there's no rush. Honestly, one of the things that I tell myself till this day, don't worry about the losing an opportunity. Worry about the capital that you have. If you have a capital, you can go and then you can take a leverage on next time when you have it. Guess what? You will have only more experience from what you have learned today by missing that particular opportunity. But if you go and trade that, you're going to have no capital when you know, oh God, I know exactly what to do, but I have no capital to trade. So trading the news is only for sophisticated traders or unless you're in the market for a long period of time.
Thank you. I think we're touching upon from the perspective of how much capital do you have, how much is the capital at risk, what's your drawdown, right? So I think we're touching upon the risk management, right?
Yeah.
So of trading. So what are your most important risk management rules? Like, I don't know, stop loss, take profit ratio, what is it?
Yeah. So again, this goes back to what we've just literally touched on. The 1% rule is a great way to begin with, okay? But risk management has a lot to do with your mentality of how you manage the trade. And I'm really telling you from my own personal experience over here, because there will be days you will lose 1%. There will be days when you will actually sit and you won't make the trade, but the trade will work in your favor, okay? And that's going to mess up your psychology in terms of that. Risk management for me is not losing the discipline. Forget about buying low and selling high or finding the exact entry into that. I tell you that the biggest fool in trading is trying to find the exact bottom or trying to find the exact low point. Because if you're going to continue to fish that, the odds are very much going to be stacked against you. It is about every week, and a lot of these traders, I can almost guarantee that 70% public sitting over here won't do it. And that comes from an experience of 15 years being in the industry. You do not study your trades at the end of the week. The biggest lesson that anyone can teach you is you by studying your own trades. That will help you to refine and define your strategy and your risk management. But before you go, you've got to have what your risk is, what and how much you want to go for. Win ratio doesn't matter that much. It is what what's your risk management in that?
So we're coming back to the, I think, psychological aspect of it. But I think there are a lot of, I know that there is not always a psychology there, right? So we see, for the past year, we've been seeing the increase in algo trading, AI trading, and machine learning. And I think, Arthur, as a liquidity provider, do you see that increase as well? Is it a different type of flow? Is it more profitable for traders? What's your opinion on that? What's your take?
Basically, what we see recently, some changes in the market, especially I think for the last 1.5 years, that copy trading solutions have been kind of deeply integrated within all the brokers, and many masters, traders actually, what basically they do, they create a lot of trading master accounts. They connect to that, to those trading master account different strategies, because basically you can find a lot of signal providers, a lot of even MQL signals, and you can build any kind of strategies based on several strategies. And then what is happening? As soon as all those masters create their trading accounts based on those algorithmic strategies, this is the most important, that all of them are algorithmic, because you cannot do this by your hand. It's impossible. You have to eat, you have to sleep, you have to spend time with your family, and the only robot can do so, right? Without any rest. And then all the investors or so-called followers, they subscribe to all those master accounts. That's where all these things begin. Because when the robot basically places the order, then thousands and thousands followers, they immediately replicate this order on the market. And that's where we see also the spikes. So that's why, Elena, answering to your question, I would say that 75% it's algorithmic trading. Besides also, which is also very important, you have to divide algorithmic traders and HFT traders, because the normal algorithmic traders, they still to try to use different strategies by using algo. When HFT traders, they try to find exploits within the brokers. It's completely two different things and two different approaches. Don't mix it up, one algo traders with another algo traders. It's two different type of traders. The first one, they are traders. The second one, they are not traders. It's kind of hackers in a trading business. They try to find the exploit. That's why when many brokers just begin their operations, the many such kind of traders, they come to the new brokers and they try to kind of abuse the trading system. And that's they are making the huge impact on overall the conditions.
That's a very good point. So there are indeed traders, and I guess that affects a little bit all of you. So very often these people would try to abuse the good trading conditions that are given to you by your brokers. So swap free, for example, and things like that. And that's why sometimes brokers might be a bit less inclined to providing people with those trading conditions, because they're so afraid of finding those abuses. And that's again about trading the abnormalities. But Arthur, just out of curiosity, and it just popped into my mind, I wonder if if traders often become your clients as brokers. Is there a lot of traders who end up opening their own brokerage firm and coming to you? Or obviously you're here, so I'm guessing there are, right?
I would say that not the traders, but the most of the brokers, It's ex-employees of the brokers and IBs. Basically, when IB created his network and he has sufficient numbers of his client base, then usually he starts thinking about to launch his own brokerage. That's why, if you can see, guys, many brokers, they have kind of, they call it institutional arm. That's the arm that are handling such cases. They don't want to let IBs just go away to the technology provider and to run their brokerage. It's better for them to share to give them infrastructure of the broker because it's already being built, and to work with IBs in a different level to kind of become a partners. So that's the the cases.
Okay. So Firdaus, coming back to you and coming back to the topic of manual versus robotic trading, what do you see at Fullerton, and in your opinion, what's more profitable based on your statistics or your knowledge or your background?
Yeah, well, it's a very tricky question, basically, because for us, we can see both manual and robot or AI trading both are profitable, basically. But if you are really following a good trading strategy, because in AI, and basically the AI is more intelligent right now, because they can choose between several strategies and make your trading profitable, right? So for EAs or robots, they are more disciplined. Because in trading, the most hardest part basically is to control your psychology and emotion, right? So these robots will help you to minimize the emotional or psychological part, you know? So when robots are trading for you, right, you are able to at least manage the 80% of the trading strategy. Basically, all the trading technical analysis, whatever that you have been learning, you already put that in the EAs or the robots, right? The only 80% that you have to manage is your emotion and psychology. That robot will help you to do that. Because you don't have to stay overnight, you know, to stay for the FOMC, for example. You don't have to stay overnight just to pick up the spike or the trades during the central bank's news release, for example. The robots will do that for you. Or even the robots have intelligence to actually close or shut down your trades during big impact news coming, right? So basically, if I would like to compare, if I had a chance to really give a between manual and trading with a good strategy, I think robot is a winner because they are able to help you manage the 80% of that psychological, risk management, money management part. Yeah.
Now, do we have anything to add to that?
I'll just add very quickly.
Yes, please. I could see you wanted to.
Thank you. Look, I think if someone is telling you that, you know what, take a larger position on any particular instrument. Like I think earlier in one of the panels, I was just listening to this one and then say, oh, just increase your position all of a sudden. That is a recipe for a disaster, really. You don't want to do that. When it comes to algorithmic trading, and we all know how Citadel makes money because they are the market makers, and then they are great in doing that. As a retail investor, using AI, robots or bots, whatever it is, I think is not the best way to move forward. You have to have your own plan in place. If you are buying a black box, it is entirely just a black box. You've got no idea what you are trading in or what you are trading against in. Just to very quickly summarize, have your risk management as the most important part of that, and then make sure you review your trades at the end of each week.
Thank you.
Elena, just small also, I would support Naeem here because, guys, if you follow some strategies regardless of who is it, and regardless of, doesn't matter how successful and profitable this strategy, do not allocate more than 5% of your capital to one of those strategies. Basically, it's better to be connected to 20 different strategies. That's the part of the diversification of the flow. Because today the strategy works, but tomorrow is not going to work. It's the always psychological circle, and every single strategy, because look, if you take a look deeply on the market, let's say martingale strategy, it has been implemented 20, 30, 40 years ago.
Yet it's successful
And it's
again.
still worse, and 50% of the strategies out there based on martingale. So that's why how you can trust that strategies.
Well, I think in the current market, I mean, let's not go into details on that, but I think in the current market, it's worth looking at. Thank you very much. Apologies that we've stayed a bit longer than we were supposed to. Thank you. Please applause the amazing panelists.
Thank you.
Thank you very much, guys.
Thank
And
you.
have a profitable trading. Thank you. Bye-bye.
Thank you.